my last video, I showed you how one of the easiest ways to buy your first property is actually to become a landlord and buy a multi-unit property. The example I gave was a fourplex, and now I want to show you the financials of how this looks from a cash flow perspective, and we can do a 10-year projection to give you an internal rate of return on your invested capital and kind of show you if you were to buy that property where you'd end up. So up here at the top, we've got the property address. It's 4 units. Each one is 2 bedroom, 1 bath, and they're 780 square feet each. Now I used the county tax record to establish what percentage of the assessed value is the land and what percentage is the improvement. So 36.89% of the value of this property, of the $650,000 purchase price, is probably going to be the land, and 63% is going to be the building. We don't know if this is exactly true, but we can always go back to this should we end up in a tax audit situation and needing to show where we got our numbers. So down on line 10, we have our depreciation schedule. This is straight line depreciation over 27 and a half years for residential properties. Now, we could also do an accelerated depreciation schedule and really improve our tax situation, but that's for another day. Line 12 is our acquisition price. This is your purchase price of $650,000, and I've built in about $5,000 for acquisition costs. This might be your inspections, taking your realtor out to lunch, things like that. Now, on line 15, we have potential rental income of $60,084 a year. So I'm taking the current rents, adding them all up. That's $1,120 for one unit, $1,248 for another, $1,239 for the third, and $1,400. Now, if we stay at those same rents and assume that maybe you're renting the cheapest one from yourself for $1,120, this is the total potential rent. Everybody's got to pay rent on time, no vacancy in between tenants. This is the potential. And we know that's not realistic. So what we're actually going to do is we're going to subtract 5% for vacancy loss. And this should say 5% for each of the additional years. I'll come back and correct that in a minute. So we know from the listing that they are claiming an operating expense each year of $11,767. And we know this is probably going to include property taxes, homeowners insurance, maybe some management, repairs. It could have water, sewer, and garbage in there. Hard to say, but we'll just use their numbers. And we're going to assume that just like the potential rental income, we're going to increase that 4% a year up here, just to put something in there. Some years we might not increase it, some years we might increase it more. We're going to assume that our operating expenses are also going to increase 4% a year. Because we're going to live in one of the units for the first year, we're only putting 5% down, and that is a financed amount of $617,500, which is 95% of our purchase price. Let's assume an interest rate at 7%. Again, as rates come down, we'll probably refinance it, and this rate will come down. Since we're living in it, we're going to assume a 30-year mortgage amortized over 30 years with one payment every month, so 12 payments a year. Now we're going to have some loan costs up front. This is going to be your appraisal fee, loan origination fee, things like that. So I put in $5,000, could be a little more, a little less. Let's assume you're doing pretty well and your ordinary income tax rate is about 30%. Your capital gains tax for long-term capital gains, should you choose not to do a 1031 exchange when you sell this property, maxes out at 20% for federal, and your cost recovery recapture tax, which is paying back that deferred depreciation, 25%. We're going to project a 10-year holding period, and we're going to assume that the value of the property is going to go up about 4% a year, which is probably less than the historic average for the Pacific Northwest, so pretty conservative. And we're going to pay our agent a great commission when we sell it, so I've built in 6% for the disposition price. This is the cost of selling the property. Now with all of these assumptions, and I need to come back up here and drag those all the way forward. And so now I'm going to go to cash flows. Okay, so here is a 10-year projection with all your cash flows. This is based off the assumptions from the last page. Line 1 here shows our gross possible income, assuming everybody pays rent and there's no vacancies. We're going to subtract out 5% because we know that's never going to be the case. This gives us our effective rental income we might expect to collect in that first year. Could be high, could be low, but we have to have some assumptions. So on line 5, we have our gross operating income, which is our total possible rents minus our vacancy loss. Below that, we have our total operating expenses, which is property taxes, insurance, possibly management, some utilities. This gives us our net operating income. Below that, we have the interest from the first mortgage at 7%. Remember, when we refinance, that rate should go down. We have our loan cost amortization. That's the $5,000 in origination fees and things. And we have our real estate taxable income of $2,120 a year. And we're going to pay $636 in taxes on that, assuming that we are at a 30% tax rate. Net operating income of 45, annual debt service of 49. So we're negative 3986 before taxes. However, we're going to have those taxes of 636. So our first year, we're negative 4622. Now, we can fast forward this 10 years, and we'll see that on year 10, we're actually cash flowing $71.60 after taxes. Not a huge return on investment, but remember, our property is going up in value. We're paying down the principal, and rents are going up. So this shows us where we are at, assuming the property went up at 4% a year. Our property we paid $650 for is now worth $962. So with a sale price of $962 and a cost of sale for the brokers of $57,720, we have a gain of $249,000. So again, down here, we have a mortgage balance of $529, which means that you're walking away with a check, assuming you don't pay capital gains tax, of $374. And this is based off our 5% investment on this property, which is about $32,500. So your down payment of $32,500 has turned into a check 10 years later for $374, $389, which gives you an internal rate of return of 25.8% per year on your money invested. How does that sound? So here is a breakdown of the before and after tax internal rate of return on your money invested. You can see that if you did a 1031 exchange at the end of this and continued to defer the depreciation recapture and the capital gains, you would have a return of 25.87% on your money invested annually. And after taxes, you would have a return of 21.52 if you did not do an exchange. So properties like this don't come along every day, but they are out there, and a good realtor can find them for you. If a return on investment of 25% sounds good to you, let me know, and I will help you find a property like this. You've got my name and number. I'd love to hear from you.